This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. All right, so here's your heat map. We had the shake and bake yesterday. By the way, it was a fake. I wrote about that last night as well. A fake Trump, we won the war, and then no, we're going to go hurt them some more, retractment. And then the Department of Energy there, Chris Wright, said, we're escorting ships through, which was a lie. They actually removed that post. Anyway, the market went higher. Oil dumped. It even went through my 91 all the way down to 70. I don't know what this is, 77. Anyway, on the fake posts, then the market retracted a little bit, and obviously it's still in stabilization bounce mode. I will say that right now, this dollar inverse head and shoulder formation look still needs to get and stay above 99.4, but I think it will. And then we've got this head and shoulders for the Qs and SPY as a potential reversal pattern. We need to obviously get back down below that kind of 606 and this 673 for SPY and 606 for Qs. But you get the idea. We still have a lot of shake and bake on this monetization or bounce Monday, Tuesday, where bulls are trying to figure out, are we really going to run it hot, this economy? Everyone that I read is expecting this de-escalation in Iran. Like, amazing. So I am such the odd man out. You have no idea. Anyway, everyone is consensus that this is going to get resolved. Okay, that's why market's staying bid. Whatever. And PE ratios are so low for the Mag 7. Okay, whatever. I see yields rising. I see an inverse head and shoulder of size in yields rising right back up to 4.2. I actually see an inverse head and shoulder right here forming for higher oil. I see a reverse head and shoulder forming for SPY and Q. And then I see an inverse head and shoulder rising for rising dollar. So I'm predicting based on just the patterns I see, higher dollar, higher oil, higher yields, lower equities. That's all I got. So nothing's triggered yet, and hopefully it doesn't. But I just want you to be aware of what I see anyway. Semis are getting an absolute bid from Oracle. Software still has its rotation. VIX came down perfectly into this, hit 22.19. So it didn't really come down enough though. So I really wanted to hit this, but I don't always get what I want. So here is that VIX pullback, sized up on Monday, just needed to come inside. 29.70, of course, 28. Here's your 27. There's your 25. All the way back down. I really kind of thought it would come down to 21.91, otherwise 22. But it stopped short at 22.19. Got a bid yesterday. Nice firm bid as markets came in. So right now it's just digesting. Get back below this trend line. We have market advance. We stay above this trend line. We obviously still need to get back above 25.20 and this kind of section. So nothing yet there. A while ago, I've kind of moved into this, let's hope for the best, but plan for the worst mode of operandi. I am still very focused on that. Warning, I don't see, despite, let's just say, a lot of bulls who are very excited about buying tech on the cheap, I am still very much focused on rising oil, rising yields, and market crash odds. So let me just show you something which was yesterday. This is actually an end of day, but if you recall, yesterday morning, I was sizing up the pre-market heat map. Okay, the pre-market heat map was the dollar moving higher. I saw this inverse head and shoulder. Gold, as a result, moves lower. I saw oil moving higher, and I saw yields moving higher. We had already moved up to 4.2% in the 10-year yield. Again, this is all on a 2-hour time frame. And then as such, I saw the head and shoulders for both Qs and SPY. And so I talked about this yesterday. Well, I took a picture of this last night just to see, because the session yesterday, as I mentioned, was kind of like the calm before the storm, very quiet. Well, I don't think it's going to stay quiet. And for the most part, big picture, you know that I saw the Monday gap down, getting bought, right tail risk, which means calls would be quickly out of the money calls would work. And oh my goodness, did they, et cetera, et cetera. And then Wednesday, we kind of, all right, that's done. and now software has taken a break. That also worked. But this little fake headline that caused crude oil to dump from 120 back down into my gap fill of 91 and then base down here in the high 70s was in fact all fake. This was Trump saying, yeah, we've won. No, we haven't. And Secretary of Energy, Chris Wright, saying, yes, we're escorting ships. And one went through 36 hours ago. That post was deleted after the fact, blamed on an intern. But it accomplished its goal of having crude dump, and this is a manipulated market. So I don't trust, obviously, anything that comes out of their mouth, which you know, but I really do have this kind of overarching feeling of we need to be more than focused on capital preservation, I think, because this is just an agent of chaos, which of course I wrote about. This is intraday, what we've got, and the same type of intonation, weakness in the market, strength in the dollar, strength in yield, strength in oil. So not a big move, but I do have eyes wide open as crash odds grow. And the reason why I'm focused on this is I started last night playing around. You know how I have that geometric mean for my gold and silver? The point is they're extremely volatile as it relates to this geometric mean of outperformance. And that's what I'm seeing right now between oil and yields. So this is not just an inverse head and shoulders with a measured move to 4.45. In other words, this measured move from down here to here is 25 basis points. So 4.45 is way up here. Remember how I said I was a little worried that this was going to get elevated? We will get up here, this 4.36. We will get up here potentially before a new channel is formed. Anyway, long story short, I believe that with every 10% increase in oil, now this is starting now. We have a new oil line in the sand, which is basically 80 bucks. So crude oil that stays sustainably above 80 bucks is gonna absolutely pull global yields higher until the market crashes. So that's why I'm focused on oil and yields so intently, with crude right now at about 90 bucks and 4.2% in the 10-year. For every 10% increase in oil, yields can rise about 5%. That's if we stick the landing above that 80 level and we just keep this swag in mind. But anyway, I'm building that geometric mean separately, but I'm just warning that what I see right now is we get to 120 crude, we're going to be at 4.86% in the 10-year. We get to 160 crude, we're going to be at 5.6% in the 10-year potential. So obviously the market, a highly indebted, highly leveraged market, will not sustain 120 crude, let alone a 4.8% handle on a US 10-year. All this being equal, that is why crash risk odds are growing in my book. Not just the other proof that I gave you of how this impacts with oil being offline and that very serious effect that we have right now also of a dollar that's starting to get a little bit busier. So we have more headwinds coming in than tailwinds. I just want you to be aware and be careful. And that's because I care. There are some really funky things going on right now. So I still have this, long story short, window where I thought we could maybe stitch together, keep it together until options expiration coming up. And I'm not so sure about that now. Percolating higher. The higher this moves, so too will yields. Don't look away. Don't look away. You got rate volatility, equity volatility, and soon currency volatility. I'll work on my write-up after my meeting at noon so you can see where I'm thinking about oil and yields. This is a call more for after options expiration because I know we could crash before that. But the point is they try to suppress volatility into FOMC and BOJ events. It is a mechanical operation and they have vested interest to do so. We had a technical failure with the German 10-year auction yesterday, but we need a trend of failures And that is a concern. Private credit is a concern, but I think this is potential reality that crash risk increases on rising dollar, rising oil, and rising yields. If we can make it through options expiration, I'd be surprised, but I absolutely still see a firm volatility regime through May. Nothing has changed.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.